Hi, I'm Keith McCullough, and welcome back to day 2 of the Investing Summit. Today, I have a focus today, okay? Generally speaking, trying to have a focus, trying to have a process here, and we're trying to get into the process of both a growth investor, long short, and a value investor. We're going to do that first. Then I'm going to get into some analysts and how they think about ideas in the third session. But the first session, I want to tee you up with how a growth manager thinks about the market. Now, growth is something that some of you may think that you should be short of when the U.S. economy is slowing. That's only in Quad 4. In Quad 3, growth, particularly organic growth, and some of the names that Mark Shattan comes up with, are the names that actually outperform by virtue of the names that have cyclical growth, like FedEx, for example, for today, continue to go lower, and value, in the case of FedEx, underperform. So it may not be what you think that it is, and that's the whole point of helping teach you how to use the 4 quadrants, and then using alpha generators like Mark to help augment why it is that he's doing what he's doing, or help you do what you're doing a little bit better, as opposed to maybe some of the biases you may have had against growth investing. People have some biases, don't they, Mark, against growth investing?
People do have their biases, yes.
Like short it because it's expensive. Would that be one?
That would be one,
yeah.
yes.
Yes. A long time you've been doing this.
Chase the hot dog.
Yeah,
that's what we do.
That is the hot thing to do. But I mean, look, at the end of the day, you've been doing this for a long time. Yeah. Want to make sure that people know where you came from. He was an Army guy, and that's important. His discipline is born to a degree out of that.
Yes, sir.
But went to Goldman, then to Jennison, which is one of the great investing firms in Wall Street history. I think it'd be hard to not make that argument with SIG and all that he's built, and how well you did there.
It's true.
And now you're launching your own fund and your own firm called GrowthLine Capital, so congratulations.
Thank you.
Yeah.
Yeah. So Jennison, actually, it's worth putting a plug in for Jennison, my former shop of the last 10 years. So if you think of the pantheon of growth investing, right? So it starts with Thomas Rowe Price, right? So T. Rowe Price had this idea that investing is not all built on Graham and Dodd, price to book, that companies that compound at high rates really generate returns. So he started that whole idea. And the next one down on that list is Sig Sigalis from Jennison. So Sig started Jennison in 1969. Howard Marks, who you're a fan of, called Jennison the first boutique. I had the last 10 years to work alongside of a guy like Sig Sigalis, and importantly, invest along with that guy through the bear market of 2008 and 2009, which was an experience I would have paid for. He wouldn't have had to pay me for that. So I would have been happy to do that.
Yeah, without experience, and again, they can be episodic, and in the case of '08, it was trending, but yeah. You infrequently have points of Quad 4 that really hammer the growth investor, which surprises people that growth over a long period of time does well. At least it would surprise people that aren't familiar with the 4 quadrants, which is growth is along in Quad 1, Quad 2, Quad 3, and not in Quad 4. So 75% of the time, you want to actually know who the growth investors are, and most importantly, who the best ones are. So that, and how they think and whatnot. So that to me is probably news, or at least to some people that we're trying to articulate to. But to you, it's not been. You've been doing this for almost 20 years.
Yeah, that's right. 22.
22.
Yes.
I'm aging you now.
Thank you.
Yes. We're about the same vintage, Gen X, I think.
Yes, we are. Yes.
Now, why now? Like, why did you start your firm, and maybe you can give people some insights on that?
So, I had arguably one of the best jobs at working with Sig Sigalis at Jennison. But about 2 years ago, when I crossed my second decade of doing this, I had that moment of, what is it I'm supposed to be doing? And the 2 people that inspired me the most in this business were my 2 mentors, so a guy named Herb Ehlers at Goldman Sachs and Sig Sigalis at Jennison. And both of those people became who it is they were meant to be by taking that blank sheet of paper and saying, this is how I invest, this is how I see the world, this is how I generate returns, building that portfolio and building a firm around that. So I couldn't, that idea stuck with me. Mm-hmm. So 2 years ago, I called one of my good friends, my classmate from West Point, and just asked him, if I was thinking about doing this, how would I go about doing it? And as a good friend, and this guy, Dave Walker, who's now my partner, he had been on the operations sides of hedge funds his whole career, mm-hmm. Post-Army. And his answer to me was, "Are you crazy? Like, don't go do this." Someone else told me that once too. And you have the best job, and just live a comfortable life. But that wasn't what I was meant to be. And what I kept seeing happening as a growth investor is we're at a phase of a transition of economies globally as companies are making what we call this digital transformation. And there are companies that are going from $2 billion of market cap to 30 and 40 and 50 and $60 billion of market cap pretty quickly. And in my old world at Jennison, we managed a lot of money. We had the good fortune of having a very successful business. And most of those companies that were 2 on their way to 4, on their way to 8 or 10, were not investable for me. And that was gnawing at me, that I'm identifying and seeing all these opportunities, can't invest in those. So the combination of timing of career, of having the confidence, the experience, the skill, a process that I've kind of refined over decades, combined with the market opportunity, said, if we don't do this now, then we'll never do it.
That's an interesting point. The whole bigger is better is a subject that we had yesterday with an RIA, Dave Root, who's rolling up a bunch of RIAs. But in your case, going smaller is better because Jennison got so big. I mean, it's effectively a big cap growth shop at this point. Yeah. Page 1 holders, for those of you that don't know, pick up any growth stock that's actually worked, and you're probably going to find Jennison in the top 10 or 20 shareholders, would you not?
That's right.
Yeah, so that crowds you out of being able to find, or you know how to find them, you're just not, it's not going to make a difference in your portfolio. Is that correct?
That's right.
Okay.
Yeah.
So big cap growth investing is ultimately what it became. But Jennison wasn't always that way. Ostensibly, their stocks were smaller and Jennison was smaller.
Well, it's relative to the market opportunity that's out there, right?
Right.
So as Jennison grew, the market grew, so market caps grew as well. But what's happening now is the opportunity of smaller companies to very quickly become larger companies is like nothing we've ever seen before. And it's really because information spreads a lot faster. I mean, if you think of how do businesses change, how do economies grow, historically you needed to find out what that good idea that was being done somewhere else. The Industrial Revolution started in the U.S. because someone stole the plans to the steam engine and snuck on a ship and came over to the U.S. and whammo, you have the Industrial Revolution. It took a long time. But today, there's very little barrier globally because information and businesses can become instantly global. So you can look at Facebook as an example. Yeah. Right? It took them 10 years to get 2 billion users. No one else has a billion anything.
Yeah, and it's amazing. And you also have, you could say the other side of information is a short seller. Every short seller that thinks that they've got it figured out starts with valuation. Or I should say a lot of them. That's a key component to how Captain Short Seller comes out there. He says, well, this stock's expensive, it's too expensive, it's crazy. You could also substitute that for, I've not been long it, I've missed the move, right? So you have a lot of people, perfect information has brought in that business school student or that person who's purist on valuation and brought the short interest high faster.
That's right.
In names that have gone from 2 to 5 billion and then they could go to 10. Part of the move could be they just have to cover their shorts, but again, at the end of the day, the companies do have to deliver the wood. They have to deliver the growth story.
Yes, they do.
Yes, so that's it's a really interesting thing. I want to get into your process. The process. You're not going to be shocked to get into process. And again, for those of you that are listening to this, what we want you to do is invest with people that have great, repeatable process. A lot of people have great ideas. That doesn't mean they have a great process. So again, Mark has a great process. It's been battle tested. You could look at his returns while he was at Jennison. They speak for themselves. But what is your process? That's a really important thing to ask anybody, whether they're an independent research provider, in my case, or in Mark's case, somebody that you're allocating capital to, your hard-earned capital at that. So you want to believe that they're going to execute on what it is that they believe in, and if they believe in it, that it's probably because it works. So can you just get into growth cycle investing? What is growth cycle investing? Because I don't know if you made it up, but to me you made it up because to me you're the first one to explain it to me, and it made perfect sense.
So the term growth cycle investing, I did make that up.
You did? Good. I make stuff up all the time.
So essentially what I needed to do was to say, can I create a phrase that captures what I've been doing and what I do, and what is this process that I've developed over a couple of decades and it has worked for me. So a process starts with a philosophy. Right, so you have to begin with some grand idea. In stock investing, it answers the big question, right? Which is, how do I make money in stocks? Right, so William O'Neill wrote a book about that decades ago, right? How to make money in stocks. But that's how a process has to begin. You have to answer that question. So the foundation for me to answer that question is the idea that wealth is created through the long-term ownership of a growing business. Right? That's for me, that's the answer of that question, how to make money investing in stocks, is find a company that compounds at high rates over long periods of time and participate in that. And if you think of the Forbes 400 as an example, the richest people in America, every person on that list is the beneficiary of owning a business that compounded at high rates over long periods of time. Right, so you have Zuckerberg and Bezos and all of Sam Walton's kids. I think there's 6 Waltons. That some of them are very near the top still from Walmart.
He's higher than some famous short sellers?
Shocking, right? And what you don't find are people who are clever. Right? You don't find people who are speculators, traders, and maybe once in a while someone gets lucky and they pop up. But that's not a repeatable process. Yeah. Right? Identify a growth company or own one, even better. Participate in that over time, and that creates your wealth. And that's what we seek to do in the stock market by owning a piece of that. So that's the beginning, how you say, okay, now I have an idea of how to make money in stocks. Can I create a process that helps me identify and own pieces of those companies called stock certificates? And so my process really is, there's 2 pieces of it. There's the art and the science. So the core of the art part of my process revolves around this adoption curve. Right? It's called the SCurve. Like, people have come across it in business school or in college, or maybe you've seen it in a magazine or a TV show, or right here on Hedgeye TV. You may have seen that somewhere. But that's the core of that part of my process, is mapping companies along that adoption curve. And that's how I view the world. I look at every company that's interesting to me based on where they are on that S-curve. And that S-curve, I mean, you have all probably seen it before. It starts at the very bottom with the innovators, and then you have the early adopters, and then as it begins to round the curve, you have the early majority, and then the late majority, and eventually the laggards. But every growth company goes through that cycle. Everyone. So it took Coca-Cola 100 years to go up that S-curve, right? And now it's in decline. Carbonated soft drink. Well, Coca-Cola's not in decline because they're doing new things like cannabis, right? Or they're looking at it, right?
No, but
CSDs are declining.
It used to be a growth stock. Now it's a mature stock. It's a value stock.
It took Facebook 10 years to go do that. So I map every company based on that, and I'm agnostic. Don't care about the sector, the industry where S&P tends to put them, the market cap, where they happen to be domiciled, or even the PE, which we'll talk about in a minute as well. What I care about, and this is sort of the core of growth cycle investing, are 3 big questions. Right? So the first question is, what is the total addressable market that this company is going for? So the size of the prize, if it moves up that curve successfully, how big is that? That's question number 1. Like, is that worth it to go up and try to get that? And the second is, what's the likelihood this company will be one of the ones to go up and do it? Right? That's question number 2. And then the third question is, if they do it, what does it look like when you get there? Is it defensible? Is someone going to come right behind you and knock you off? Does it have high returns? Or are you continually reinvesting, to just stay in place and actually never get to harvest? We call that profitless prosperity. So those are the 3 big questions.
Or a nice chart.
Or a nice chart, right? Which then can become an interesting short opportunity.
Right. Yeah.
Right. And the reason that's art is because that's a judgment. Right, so the ability to say this company will be a winner and that one not so much, that comes with trial and error, pattern recognition, investing in growth companies for decades with real money having to live with the consequences of getting that right or getting that wrong.
Right.
So I like to say that's something that you probably can't teach to someone, but it's something you can learn.
And when you say patterns, that's fully loaded with behavioral patterns, which matter big time, because you're constantly vetting what management team, what founder, what are they telling you, what have you heard before from other management teams. There's a sneaky suspicion to some people, and it's for a good reason. They're full of it.
That's right.
So you go through that enough times, and just like any fractal pattern, there's self-similarity to the winners, and there's certainly self-similarity to the losers, I would imagine.
That's exactly right. So you're making a judgment on the answer to those 3 big questions based on all of these patterns that you've seen over the years, and that's That's skill, but more importantly, experience.
Yep.
Right. So that's the art side. And the science side is, okay, now I've identified someone that answers these 3 big questions. And I think the answer is yes.
Well, it's like quantified art, though. Like, you're not just like, nilly-willy, opining on what these
Oh,
things
that's
be,
right. That's right. No, for sure, right? This is,
you're building a model, you're building out the market share, viewpoints, et cetera.
Well, and that's where you get to the science part, right? So then I say, okay, I got this company that I think is going to do this. It's going to go up this curve, capture that TAM, and it's awesome when they get there. Now what do you do? It's like, well, now you got a stock. So is that a buy or a sell or a hold? Like, what do I do with that? So now you need a framework, right? So this is the transition from strategy to tactics. Like, so you mentioned my military background. So at West Point we would study strategy a lot and tactics a lot, and there's a big difference that a lot of people kind of conflate the two.
Yeah.
And so strategy, just in the military framework, that's how you win the war, right? Tactics, that's how you win the battle, right? But you got to win the battles to win the war, and you need both, right? You can't have one or the other. Sometimes people are totally focused on strategy. Sometimes people are totally focused on tactics, but you really need both. So the big strategy is this growth cycle investing framework that I talked about. Size of the prize, likelihood it moves up, and what does it look like when you get there? The tactics are, okay, now this is to what you were speaking of. Let me model out, project the financials of that company as far into the future as I can with some degree of confidence. So for most companies, that's typically 3 to 4 years, because beyond that, it's just a bit of a wild guess. What that essentially modeling is the path the company moves as it moves up that S-curve, right? Sometime in that future, that farthest out point, 3 or 4 years, I say, okay, now I have an image of what I think that company looks like if they're reasonably successful moving up this curve in the next 3 or 4 years. Then I say, okay, at that point in time, what is that worth? Now this is where it gets contentious, right? So you and I can argue about this, right? So if we look at
lots of opinions,
there are lots of opinions, right? The characteristics, the market that they're still going after, the success they just had, kind of the provability. We could argue a lot about what is that 10 times sales, is that 20 times EBITDA, is that 30 times earnings, but I bet we can agree on a range, right? We will get to some range, and maybe it's a wide range, but we'll get to some agreement on a range. So I create that range somewhere 3 or 4 years out in the future. Once I have that, now I have an endpoint. And I just map that range back to where we are today.
Along the S-curve.
Yeah.
Yep.
Yeah, that's what that is.
How fast is the company moving towards your target versus, how much longer could it potentially take?
Yeah. It looks like a big fat arrow moving up and to the right.
Yeah.
And now I can just map the stock versus that range. Now I know where I am versus where I think I should be going.
Yeah.
And so that's the science part. And that's just the repetitive process of map it on the S-curve, project it, figure out what that range looks like in the future, and bring it back to today. Map the stock versus that.
Now that's, so I'll just draw that because you mentioned it more than enough times at this point. Guys, can we get just a nice clean sheet of paper? So we have an S-curve.
There it is.
I shouldn't have added my own little drawings there. But ostensibly you're saying, okay, any company, whether they're lying to or the next Amazon, starts here, right? And you'd like to sell it here. In fact, you'd like to sell it and then potentially short it there.
That's right.
So the only question, or the biggest question, is how quickly do you move up this curve, which you call, and I've seen your new beautiful GrowthLine presentation, how quickly do you move, up this part? Now, if you were to, what are the phases in here, by the way, Mark? You have phases that you named.
Yeah, so I created essentially three different life cycles of where this company will move through. So the lower half I call the venture. Okay. Right. The middle half I call emerging. The middle third, I should say, and then the upper is maturing.
So this is separated basically in thirds.
That's right.
So in here you're basically venture. In here you're what?
Emerging.
Emerging. And here you're maturing?
Maturing, yes.
Okay.
Not mature.
Okay.
Maturing.
Okay, cool. So this is, and in venture, actually, and that's what's happening in the private market, is that the market caps, like you say, they go from 2 to 5 to 30 in the case of wherever they're going to bring Uber, they could be at 100 by the time you get them.
That's right.
So there's a huge game within the game that's going on in this mosh pit, and that is pro-cyclical, but it's also based on where we are in terms of technological change, which is your main premise here.
That's right.
Is it, you could be on bullish cycle, 10 straight quarters of economic growth in a row, which is pretty, well, first of all, it's a US record. But you also have a lot of technological change.
That's right.
So that's where this is why you're saying that this area is so fervent.
It's a great area. There's a high failure rate down there.
Yeah.
And as you and I have talked,
is there like a number you could put on that? Like how many companies are full of it or fail? Like we call them the F-squared model.
I should do that. I don't know. But the F-squared model, that sounds good.
But by the time they get in, if you could, you would obviously own everything in there or back here. You know, you'd own the company, like you said.
Yeah.
You'd be like maybe this Hedgeye guy, this crazy guy. You know, you just buy it. You own all of it.
That's
know,
right.
that's where you'd ideally own it. But can't you make a lot of money by like actually being late and buying it here or here?
Absolutely, yeah. So companies that move up, they have a higher failure rate as they're in the venture stage. And so when you're down in, I just kind of created these names. The venture stage means the TAM is starting to come into focus.
Okay.
Right. And
TAM is total addressable market
yes.
for you guys that don't know that.
Thank you. Yeah. So the TAM, the total addressable market, is beginning to come into focus with what's addressable with these companies, with what they have right now.
Right.
So, for instance, blockchain, Bitcoin. It's very interesting to me, but it's not investable right now because I don't know the TAM. I don't know what we're going to do. I think we're going to do really interesting things with that, and companies will make a lot of money doing that. But I can't figure out that TAM.
This is exactly what Neil House said yesterday. He said, it's cool, I like the technology, but I can't, unless you can show me, right. there's no total addressable market here that's been validated yet.
We don't know what that is.
And just saying it's cool isn't an investment, correct?
That's right. That's right. Then it's a science experiment or a hobby.
Whereas with cannabis, like you can ask Shane Laidlaw and
yes.
Howard Penny, bingo, they'll tell you right away what they think that the minimum total addressable market is,
right.
and what the blue sky could be, which is a lot higher. So you're starting with something. So that's where you're starting when you get out.
Cannabis is down there right now. So we're doing work on that now.
So you put, and I've seen your presentation, but you have a series of things that are, which we can get into in a minute, that are interesting growth opportunities at the subsector level.
That's right.
Of growth,
yes.
right? Okay.
Yeah.
So you bucket it, and then you go from there.
Yeah, that's right. Right. And so when you move up the curve, so emerging. So this is where now
emerging's here. Yeah.
Emerging's in the middle.
This
right?
is this part.
Right.
Yeah.
So now you have a whole lot of companies that are competing for a clearly defined TAM, but now you're getting down to a handful of winners and maybe some losers.
Yeah.
So an easy example to think about in that bucket right now is like restaurant delivery. Right, so there's one public company is Grubhub, another one's coming soon is DoorDash, and Uber Eats is out there, and Postmates. There's a handful of companies. We know that TAM now is very well established. The growth of that industry is 50% right now. It's growing like mad, as people have become accustomed to. I want my movie theater brought to me by Netflix, I want my mall brought to me by Amazon, and I want my restaurant brought to me by Grubhub, DoorDash, someone else. Like, I don't want everyone to leave my house. Like, this is where I want to be. Neil Howe probably has some interesting stats on that as for millennials versus Gen Xers like us. And so now you have a handful of companies that are fighting tooth and nail for this big prize that's out there, because this is a scale business, right? We know what those look like when you get scale network businesses at size, right? So this is a big fight. When you move up to the maturing growth, now you have dominance, right? You still have great growth in front of them. So think of, there's still wonderful growth in front of us. Think of Facebook as an example, which might be a bit controversial, or PayPal is a fun one to talk about. That's, they are now the winner. And you're looking ahead as what is the compounding growth of them as they continue to move up that curve, which can happen for many years. Now, something
that's important. In the M phase, the duration, there are many different lengths of time that can last.
That's right. That's right.
I mean, and all these curves, to be clear, have different compression and duration.
Absolutely.
Okay.
Yeah.
Yeah, so that's where, that's actually where you start to find some shorts at the end of that story.
Yeah, because what happens is, as companies move up this curve successfully, for whatever it is they do, when they get to the top, when they get near full penetration, they're almost always priced as if this goes on forever.
Yes, exactly. Right? Well, now everybody owns them. I could name a few. I'm not going to get into my ideas on this, but I know what my analysts' ideas are on this.
Yeah.
So, once you get into that, this is where the happy hunting begins as a short seller. Let's just change the color, okay? In here is where, because if you get any kind of a deceleration that you start to project as a long-term decel, a long-term degradation in terms of cash flows, revenue growth. That's what I'm looking as a short. That's what I only look for as a short seller, to be clear.
Yeah.
You know, but it's still just reversing what you like.
It's the same framework. It's the same process. The tactics are just different.
Right.
Right. Again, there's a difference between strategy and tactics, and that happens all the time.
Yeah. So if this is time, then really your shorts are, you have them in here. This is happy, you know, short selling. Whereas you got this big block of time where there's plenty of opportunity to squeeze the shorts.
That's exactly right. Yeah.
Or screw up, where you buy a company that is a venture company that's lying to you, and
you get it wrong.
Yeah.
Right.
Okay.
Right? And then you move on and find the next one.
Yeah.
So we like to say you don't have to own every stock that goes up. Just make sure the ones you do own go up.
Yeah. You learn some of these things from SIG. They're pretty basic, right?
Yeah, you can let the other ones go.
Yeah.
And but yeah, that's a good depiction of the framework.
Just because we get a lot of questions that are coming in now. On some of these, I guess, would you call them trends? All the, you know, if you think of all the different topics that you guys are
trends
working,
or themes.
Themes,
yes.
trends or themes.
Yeah.
You want to go through maybe you already mentioned one, which is food delivery.
Yeah.
Like maybe rattle off like half a dozen. Because you have, I don't know, how many do you have? Like 18, 25?
Oh God, we have a lot. And what we do is we just keep putting some on as we come across new ideas that are interesting. I mean, one of the things people ask.
That's the thing. Like everybody, this is America until somebody changes it. Who knows?
Right.
But you know, in here, there's a lot of Americans coming up with new stuff
all the time.
All the time.
I mean, some people ask, like, you know, how do you find ideas? And I like to joke. It says, walk around with your eyes open and be curious, and say why. Why is that happening?
Yeah.
You know, why is that stock going up? Or, you know, I have 3 teenagers, and you know, we were looking at Canada Goose as an example, and I asked my son about Canada Goose, and because I saw a lot of people in the school had it, and I said, you know, Davis, like, you know, I'm thinking about Canada Goose. What do you think? And Davis says, Dad, you got to buy the stock. He's 17, right? So why? He says, because every kid in my school has one.
Yeah.
And I said, Davis, who's going to buy one next year? Like, oh yeah, Dad, you got to short this stock.
That's great.
But it's really,
it's Canada Goose. When, like, being Canadian, there is something special about walking around doing meetings with, you know, guys like you.
Yeah.
Door to door. I'm just wearing a suit, and I see a significant amount of New Yorkers on a day that's 40 degrees wearing faux fur, like they're cold. You know, it's like, and then you knew what was going to happen next. At the next Super Bowl, some rapper's going to come out with full, real deal fur, right?
Yes, every time. Yeah.
But those jackets, they might cost you a little bit more.
Those may cost you a bit more than a lot more than the Amazon jacket, which is competing with
a full mink.
Yes.
Yeah. So within these, I interrupted you.
So things. I mean, there's all kinds of interesting things down there. So you think of, you know, mobile broadband, right, which is sort of 5G.
Yeah.
Lots of
5G. That's epic.
I mean, and this is coming.
Yep.
Right, and this will change a lot of how we do things.
Is that the back half of this year even? Like 5G?
So the first, I mean, Verizon and AT&T are working, you know, feverishly to get it out. So we'll start to see the first deployments back half of this year, is what they say.
Yep.
But you know, we'll see. But when you have, this is a structural change in having broadband wherever you are, whenever you need it, whenever you want it, much more reliably. Right, so there's all kinds of things that will change. Maybe that enables autonomous driving, which is one of these trends that we're looking at.
Yep.
So that's one at the very bottom, where we're trying to figure out, what is that TAM? What's the real TAM of that? Right now we don't know. Will 5G enable that and make that into something that's investable?
So a lot of these things can be interconnected and perpetuate the others.
In many cases, they are. Right?
Yep.
So, you know, down there you have, you know, the gig economy. Right. We're talking about Uber, and, you know, Lyft is going to, you know, the roadshow is happening right now for their IPO next week. Right.
Yep.
So we're changing the structure of employment. Right. That's a fascinating area to invest in. Right? And that creates a whole nother slew of problems, like, you know, how do I provide benefits? You know, how do I get healthcare insurance? Right? That's interesting. Does that make you know, a PEO company interesting? You know,
yep.
And so there's all kinds of different offshoots of that. So you have things. Electric vehicles is one that we talk about a lot. So, you know, this is, you know, we're still inning 1.5 of the penetration of electric vehicles. As you know, at my previous firm, we were a very large shareholder in Tesla, which was a bit contentious. But Tesla, in 2013, when we were beginning to accumulate the shares, this was at the bottom of this S-curve.
Yeah.
But it answered my 3 big questions. right, sold per year. Tesla's trying to get to 50,000. That's 5 basis points. Like if the car is good, if it works, they'll probably get that, right? At that much at least, right? Massive TAM, right? That they're going after.
This is back in 2013.
This is in 2013,
yeah.
right? And so we went out and visited and saw this Model S, and it was like an incredible car. So this is, if this car works, it's better than most of the other cars that are on the road right now. People are going to want this, and it happens to be electric. So stock was $50 back then.
And this is when, if you asked your son, is that a cool car, and how many of the kids at school's parents have it, they couldn't get it.
Couldn't get it. Couldn't get it.
Now they all have one,
right.
And they're used.
So, I mean, EVs are fascinating.
That's a big topic.
It's a big topic. Where you're going from 1.5% of cars today being produced that are electric.
Yep.
And there's lots of different estimates just based on kind of how that grows over time. But that'll be 5, 6, 7% over the next 5 or 6 years, we think. And there's lots of interesting opportunities to invest along that may not be Tesla, by the way. Who are the arms dealers to electric vehicles? We look at lithium companies as an example, as an arms dealer to who makes electric vehicles.
Like ALB, for example?
ALB, or there's a smaller company called Livent, who's a spin-off from a chemical company called FMC. That's one that we spend a lot of time on.
It's interesting.
Right now.
Like I say this to Van Sciver, who I'll have on later today. If I look at the trend signal, because I have a risk management process for this as well.
Yes.
And the trend signal, it could be bearish on Tesla, but I could have a basket of 12 names that are plays on EV that are all bullish.
Yes.
So it's an amazing, like you get games within the game and early games as opposed to the consensus game that people have. To me, like your world becomes more interesting as you talk about it more.
As each layer you unravel, and so you can begin with the thesis on EVs that 10 years from now, EVs will be 5 to 7-fold the size of the market today.
Of the actual EV market.
Of the actual EV
market.
Right. Right. That growth rate of all the things that you need to make electric vehicles work, a lot of things are going to break in that. To grow, like the lithium industry has to keep up with that.
Yeah.
That's hard. And this is big mining, right? It's really difficult to get this stuff out of the ground. Like it's there's a lot of it. I think lithium is number 3 in the periodic table. It's in the earth. It's in seawater. Right? You can get a lot of it, but the process of getting it, processing it, putting it in the format that you need to make a lithium ion
compliant
battery.
Format for EV.
Right. So there's an example of an arms dealer who they don't care which EV wins.
Right.
They just know this industry is growing.
So
like
EV
mad.
would fit where on this curve? Like
so rounding the curve, right there, rounding the curve at the bottom.
EV would be right in here.
Yep.
Right? Like so you're coming out of the venture
you're
into
going from what's called the early adopters to the early majority. Right. That's where we're heading.
And for those of you who haven't seen it, you could probably get a hold of Mark and he'll give it to you, or at least help with how he looks at the world. He basically puts every one of these sub-growth topics along the S-curve. Then you have your companies on the S-curve too.
That's exactly right.
Because I do want to get to some questions. You mentioned PayPal. Where does PayPal fit on the S-curve? Just putting a stock on the S-curve.
Yeah, so I would put PayPal right where you have the dotted line between E and M.
Okay, so now we know what EV is kind of in here, and PayPal, which is
digital transactions, right?
Is gone from payments and digital transactions is there. Okay. Right. What's the ticker on PayPal again?
PYPL.
Okay, so we can put every ticker and every subtopic of growth along this S-curve.
That's right.
Okay, cool.
That's right. Yeah, and there's one where the TAM is massive, right? It's digital transactions, right? that's a big thing, right?
Yes.
As the world goes from paper to digital, right? So it's fascinating if you look at the percentage of the U.S. that's digital versus Europe. So Europe is 10 to 20 years behind the U.S. and Asia is 10 to 20 years behind Europe. If you think of what's the long-term structural path of digital payments, and ever since PayPal did they had the great peace deal with all the credit card companies when they split off from eBay. So PayPal used to be owned by eBay.
And they spun it off.
They spun it off. And before PayPal...
Did you guys buy it when they did that? Or was that like...
so that was in my former life, yes. Yeah.
You're allowed to say that, right?
Yeah.
I mean, it's public information.
That's true, yeah. We were running public mutual funds.
Yep.
Yeah. So yes. But because now you had an independent company that could then go make peace with all these credit card companies. And I call it, when they signed this great deal with Visa, MasterCard, Amex, saying we're no longer at war, we're going to enable each other in this future growth. I call that the Netflix moment. And so Netflix, I think it was in 2013, I may have that date wrong, they had that big deal with Disney, right? And so Netflix was struggling. Everybody said this is a fantastic service, could be a great benefit to me, but the content stinks. Like they just don't have enough good stuff yet. And then Disney said, let's do a deal, and you get all of the new content that we do for I think it was 3 or 4 years, and then all of a sudden, Netflix became Netflix, because now it's compelling. Like now they have real content that I want to go, and my kids will watch the cartoons or the Pixar shows that are coming out. Now you have real content. PayPal had that moment.
Yep.
When they made the peace deal with all the credit card companies, and so from here they become the default for digital commerce. And that gives them many years of growth ahead.
With growth components to it. People don't know what they've created within PayPal.
Oh, well, so Venmo is a fascinating part of it. I mean,
everyone here, like, Venmo me. And I'm like,
yes.
Gen X guy, and I'm like,
you have
I got
a lot
cash.
of millennials here, right?
I have
Yes,
cash,
yes.
and they want to do Venmo. But I mean, this is like, this is where the world's going, obviously.
Yeah, and they're very secretive about the financials of Venmo.
Yeah.
And so we've been trying to figure out, it's probably, it costs them maybe 10% of their earnings, we think. It's hard to pinpoint that number because they won't tell you. And what would that be worth on its own?
Yeah.
Probably about $15 to $20 billion on its own.
Wow.
If it were just independent. That's a guess. I don't know the numbers. So I'm guessing based on the transactions that they tell you what we think that's worth.
So does that happen frequently where, I assume it was the same analysis, or just metaphorically, Facebook with Instagram? They're not going to give you all the Instagram numbers, but if you could be long, just only be long Instagram, which they bought, you would.
Absolutely, yeah.
So does that happen a lot, where you get these companies that are they're going from E to M, and not ironically, they do have to buy companies that are down in here.
That's
right?
so common, right? So Facebook is a great example, right? It's 5 companies. Right? People don't think of Facebook as 5 companies.
Exactly.
It's core Facebook, right, which is maturing. They're not adding users, but there's still tons of use cases and monetization for them to do. Right? Then there's Instagram, right? Then there's WhatsApp, and there's Facebook Messenger, and then there's the one that people don't talk about much is their virtual reality, augmented reality business called Oculus. Was an acquisition that they made as well. And each of these are at different phases of their own life cycle. So good management teams think maybe instinctively about where they are on this curve.
Yeah.
And they know that their core business is going to be hitting that later stage, and they need more if they want to keep having a growth.
Which in particular, when U.S. growth is at the peak of an economic cycle, which it was in the third quarter of last year, you can see that money's flying all over the place, and these transactions are happening faster because the companies are insecure to a degree that the next up-and-comer becomes them. So why don't they just buy them before that happens?
That's right.
So again, it's where you got these mega caps ostensibly, as opposed to just big caps in growth.
That's exactly right.
Yeah, because they're buying growth. They're buying this down here before you can buy it.
And which is what Facebook did with Instagram, to your example. That's exactly what they did.
Yeah, I love this framework. All right, let's get into some questions. Actually, before we take questions, shorts.
Yes.
Okay. Your strategy. This fits over here too.
That's right.
So maybe one short that fits the profile. I'm assuming it's nothing like PayPal or electric.
It's not. Although there are. What happens is if you think about that framework, you find companies that are remember that big fat arrow moving up and to the right.
Yeah,
This is the value TAM of how I think this company grows over time. You do find companies that are just so far above it. There's even though they're growing really fast and they're going to move up that curve, you can't make money in the stock, right? So like I was a shareholder of Splunk. You may know the company Splunk. Fantastic company. Stock peaked, I think it was in February of 14 at $106 because everything just went great. Like this is a company that does their buzzword. Everybody has a buzzword in growth companies, right? Big data analytics. Yeah. Right? It sounds sexy, right? It's really, really cool. It was fantastic. They were early innovator, creating this whole end market, growing like mad, 50, 70%. The next 4 years, the stock was between 40 and 70. Yeah. And they never missed a number. Right? They beat and raised.
The street just priced it all in.
They did price it all in, right?
Yeah.
So you do get some of those, but in the cases that you're talking to here, you find short opportunities of companies like that are rounding that turn at the top, but priced as if it goes on forever. So an example that we've talked about is Texas Roadhouse. It's a great restaurant chain. I've eaten there. I like it, and they offer a great deal for their customers, like about $17 for a steak dinner. That's pretty good.
That's about as cheap as it gets.
That's about as cheap, and it's decent. It's decent food, and it's been a beautiful executor. Now they have 540 restaurants. There's, I think, only 3 casual dining restaurant chains that have hit 1,000. Right? There's sort of a difficulty when you just think of TAM, right? What's the size of the market that they're addressing and competition? So they're starting to near the top of there at the same time they get this massive cost pressure. So wages are beginning to rise, so their margins are getting squeezed a bit. So you have a company that is peering over the cliff. But
your cliff is the S-curve.
Is the S-curve, but priced as if it should go on forever.
Yeah.
And so that creates an interesting short opportunity.
Yeah. So there's be many of those too. I mean, I think you'll do better with this because Jennison, of course, didn't short stocks.
No.
But I mean, you can not only short the stocks that you would have sold because they're no longer fitting your profile and they're entering the wrong part of the S-curve, or you can just have outright shorts.
Or just the ones to avoid.
Right.
When you think of this framework, there's so many companies at the bottom that are trying to make it up to the top. Almost all of them won't make it.
Yeah.
Right? There's a lot of interesting short opportunities.
Yeah. And what I also love about your strategy, and I finally am going to get to your questions, is that most hedge fund guys are so smart. Like, they're value guys.
Yeah.
That's the smart, you know it's cheaper than everybody else.
Yes.
But how many hedge funds are outright growth investors that can articulate the process that you just did and have? And capitalize, most importantly, on the big growth run we just had for the last 2.5 years, and then understood during quad 4 at the lows to buy all those things back, because in quad 3 they work too. I mean, I think it's a really good time to be doing what you're doing, and you don't have a lot of competition, whereas in the value space there's a tremendous amount of competition in terms of how hedge funds run long short. Questions? All right. Let's see. Well, there's a lot of comments. As soon as you started making comments about stocks, man. Is it possible to see your growth cycle investing presentation? Do you have to be probably have to be an institutional investor to do that?
That's right.
Yeah. Or a qualified investor. If you are, the answer is yes. If you aren't, no. Let's see. Hydrogen fuel cells. Would you put this? Where would you put this if you were to put it anywhere on your SCurve?
Yeah, so I haven't done enough work there. It's interesting.
He's asking about Plug Power.
Plug Power is, I actually know this company a little bit. It's very small, but they are a leader in that, and I don't know the TAM. So here's one.
I'm getting lucky. The last 2 days, I had 2 of the smartest guys I know use the 3 words that nobody ever uses. I don't know. Love it. That's awesome. Mark, in the repeatable part of your framework, the science and alchemy behind the VEM model, I guess they're calling this the VEM model now.
Okay.
There's a V and E and M.
Trademark that.
What quantitative metrics are you examining? What quantitative metrics are you using to examine the transition between the V and the E and the M?
Yeah. So the V, the E, the M, those dotted lines are reasonably arbitrary, right? So
it's a framework.
It's a framework of understanding the dynamic of the company and its competitors in relation to the addressable market, the TAM that they're going after, right? So the metrics that you use are the same, right? So it's what does success look like if they get there, right? Now let's model that out as far as we can with confidence.
And you don't go beyond 3 to 4 years. That would surprise a lot of people.
It's really hard, because it's hard to have any degree of confidence. So we can dream and imagine what that could be 5 or 10 years from now, but that's not an investable decision, right? That's maybe 2 years from now. You still have 3 or 4 more years beyond that.
Isn't that the coolest thing? Like, you guys effectively created boutique growth investing at Jennison. And you're going to say, I'm not going to really model out beyond 3 years. Whereas some people they're like, well, I have a 10 to 20 year view on this. And the guys who are the best at it have the sobriety and humility effectively to say, I'm not going to go beyond 3 years for now.
It's hard.
That's tough.
That's
right?
really hard. I mean, maybe in like drug companies. But one of the things that's interesting as you think about this framework, near the bottom, all of the traditional valuation metrics that we all use all the time, PE or EV to EBITDA, doesn't matter. It doesn't matter much. What matters down there are the answers to the big three questions, right? Size of TAM, likelihood that this company moves up and gets it, and what's it look like when you get there. As you move up that curve, now valuation begins to matter a lot more because you're now starting to run out of room, right? Till you get eventually to the top, like this Texas Roadhouse example, where there's not a lot of room left, right? And yet you're still priced for much growth.
Yeah, and now you can put quantitative bands on that. Howard Penny would say, if a casual dining restaurant like Texas Roadhouse is trading north of 10 to 12 times EBITDA, that's as high as it can go when it's a growth company.
Right.
I mean, maybe it's a hyper-growth company, Chipotle traded at a higher multiple, but there are bands that have been defined quantitatively as to where the market is not going to pay up for a company that's slowing. You don't know until it starts to slow.
That's exactly right.
Is one answer to his question, and the way I think about it, or at least the way I try to teach my analysts is, if the revenue growth rate continues to accelerate, then you know what you needed to know. I'd like to know that more than I need to know the multiple of the stock. Amazon was always an expensive stock. But when was it that the company's growth rate started to accelerate at a faster rate?
That's a big clue into two big things, right? So if they're the growth rate needs to be high when it's near the bottom, meaning like north of 20% high.
Year-over-year growth rate, the rate of change.
Year-over-year growth rate.
I'll be damned, the growth investors care about rate of change.
Who knew? Trademark that too. So a fast growth rate and an accelerating growth rate that is fast tells you two things. It tells you that the TAM is big. Right? Because they're growing really fast because this market is so desirous of whatever it is they're providing that they can grow real fast. And it also tells you that they're, if everyone else is not quite growing as fast, that they seem to be moving up the curve faster and maybe will be one of those that make it up there and win.
Okay. Mark, in terms of where you start with the process, do you generally find that your best ideas start with identifying a big theme and then finding the companies within the theme, or the other way around? Or neither?
Yeah, it's both. It truly is both. So sometimes you find just an individual company that you came across it at a conference or a report that says that's interesting. Why?
Like Plug Power. Somebody's pitching you on it. You come across it. You meet with the company.
But in general, you see electric vehicles. I can see this going from 1.5% of vehicles roughly today to 10% in 10 years or somewhere along that, and a lot more beyond that. That's a theme. Now, how do I invest in that? Right. So it's both. It's both.
How do you identify market trends that lead to increasing or decreasing TAMs? Because I assume, this is implying that the TAM can change. It can initially be considered high, and then it's lower than what you thought, or it can be higher than what you thought.
So TAMs, they do change, and often they change because of what a company does. And I think one of the best examples was Amazon. Right. So Amazon,
a company perpetuates its own TAM.
Well, they created new ones. Right? So what's interesting is this is what growth companies do, and people, it depends on your framework of thinking about them. But so we all think about that economic pie, right? That when we talk about companies trying to get pieces of that economic pie. Growth companies, that's not what they're trying to do. They're making new pies. Right? They're just saying, I don't want to steal your market share. I want to create a whole new market that didn't exist before. And so Amazon is the prototypical example of that. And if you think of the origins of that company, the TAM was books and CDs selling you through the website. Right? That was not a huge TAM. Right? But then you can say,
when the stock struggled.
It is when the stock. But then they said, oh wait, we're going to sell everything. TAM, much bigger. Right? But what was fascinating when you think about a new TAM is Amazon Web Services. Right, so here's an example of a company saying, we're really good at this thing called cloud computing because we need it to run our business. Maybe we could do this for other people too. And of course, they were the catalyst that created the cloud computing that we know today. That TAM is arguably bigger than their core TAM. And so that business within Amazon, that could be worth people speculate.
And that's really when the Amazon multiple really blew the shorts out of the water, is when they didn't realize they had Amazon services underneath the hood, and that growth rate ripped.
That's exactly right.
And that was cool to see. Mark, can you please comment on your biggest mistake or mistakes, what you learned, and how you avoid making those mistakes again in the future? Thank you kindly, Jeff. I think that's a good question.
Yeah, that's a fair question. So every time when I make big mistakes, it's usually thinking of the art side of the process, and it's getting one of the big three questions wrong.
Oh, really? So it's like your initial premise is just wrong.
Because again, this is the art, right? It's judgment, right? And so judgment is based on experience and pattern recognition, trial and error. And so you see, you go through this process and you see things like one way, and it turns out they're not that way. And so, and then you live.
Can't imagine that ever happened.
And this is when I talk about, the judgment is driven by experience. Experience comes with scars, right? You earn those, and you're very proud of those scars. But I think of a fun one now. I can laugh about it. Was 3D printing, right? So back in 13 and 14, I was very interested, as I thought this TAM was massive, much sooner than it turned out to be in reality, of what that industry would. So I own Stratasys and 3D systems, and if you look at the stock charts, it looks like a sine curve. It went up and down because
you want an S, not a sine.
You don't want the end of it, because the stocks are priced for a TAM that I thought was legitimate and real, and they weren't able to address all the manufacturing piece, going into different metals, being able to just produce additively as opposed to the old way, whether injection molding or subtractively, taking away something from what you're trying to make versus building it molecule by molecule. And so there's an example where I thought the TAM was X, but it turns out it was X divided by 70%. And so there's this is where you make the mistakes, or you make the mistake of a company that isn't going to be the one to go up.
How much time do you usually have when you make a mistake? Like, is it quarterly that you have a chance to recalibrate?
Yeah, that's right. So what happens is you're getting signposts along the way, and every data point you get is helping to frame sort of that path that company is moving. And so as the company is moving along there, they'll report earnings, and you'll get results, or you'll hear a competitor talk, and each data points gives you more confirmation or less confirmation that those assumptions that you're building into are either correct or not correct. And sometimes it's dramatic, right? You see, some companies where the results are so different than what you expected, and the stock results are also dramatic when that happens.
So we have this in common as well. I mean, I'm bean counting macro data points. What quadrant are we in? Yeah. Every day is a new day to change my position. Every day I get a disconfirming or confirming data point that we're in that quadrant.
That's exactly right.
You're doing this daily because you're doing your research daily, obviously, but you're also doing quarterly. The company either validates where you thought they were on the S-curve or not. Yeah. And that's just, I guess that's why we get along. Because there's a data dependence to what you do that I think that I finally, I've known you for a long time, but I think you just articulated in the last 50 minutes, and unfortunately we have to go, but you just articulated that, and you used the word art, but you really do have a repeatable process that really is refined and quantified.
That's right.
Yeah, and that's awesome. I think you're going to do really well with this, so thanks for it to people.
Thanks, Keith.
Yeah.
I appreciate it.
I appreciate that.